IPO investing is speculative and not for everyone. While there are extraordinary short-term gains to be made, losses are inevitable. The key to successful IPO investing is accessing underpriced deals with strong demand signals at the IPO price. But there are plenty of landmines. In this episode, we'll identify 8 common IPO investing mistakes so we can avoid them. And stick around for number 5 because it's the most common IPO investing mistake by far. Welcome to the Access IPOs podcast, where we explore opportunities to invest in the world's most innovative and disruptive pre-IPO companies. I'm Craig Stevens, founder of Access IPOs. IPO investing can be a great way to make some short-term gains to balance against your long-term stock investing portfolio. IPO investing is speculative, but speculation is okay in a DIY investing portfolio. About 95% of my retirement portfolio is pretty boring index funds in both stocks and bonds and international, but I take about 5% of my invested assets and I speculate with it, either with individual stocks or IPOs. And I like IPOs because I've been following the IPO markets for more than a decade. I've invested in dozens of these deals, and I monitor a lot of these companies on my website as they progress from a mid-stage startup that's growing fast into a late-stage startup and ultimately to an IPO debut. And since I identify these companies earlier in their cycle and wait for the right companies to IPO, it gives me an advantage over the average Joe investor who's just out there looking at the next hot IPO. So while there are really good gains to be made, there's a lot of room for mistakes and there's a lot of risk. So it is speculative and it is risky and you can definitely lose money. And we've seen that several times this year where certain IPOs we had high expectations for and they fell through. And there were some warning signals headed into those IPOs. And so we'll look at a few examples of that from 2025. Common IPO investing mistakes that we've all made, but if we can identify them and be warned ahead of time, then it'll help us avoid them in the future when we're looking at the next deals, especially as we head into the next year where we're expecting higher IPO volume. So let's jump into the list. My first IPO investing mistake that's far too common is investing in the IPO and not in the business. Most of the IPOs that happen in any given year, we have never heard of these companies, and a lot of times we will never hear about them again. That's sort of their debut. But they don't have a lot of name recognition. They might be holding companies or just small companies that just aren't on our radar. They're not going to get on our radar, and maybe they don't have much of a growth story, but they're using the IPO to raise some money. These IPOs I'm just not interested in. I ignore 90% of the IPOs that launch every year. That's because there's no name recognition. They're probably not playing in a big market where the total addressable market is significant enough for these companies to grow. There's no buzz on the internet or in the forums about these companies. However, sometimes these companies that we've never heard of show up in our brokerage accounts. We are offered IPO access to these deals. And I have readers reach out and say, hey, what do you think about this deal? And I pretty much tell them, like, I'm not paying attention to that company. If there isn't name recognition, if the company isn't a leader in its field or in its industry, it's just not going to be on my radar. So I only invest in these companies that I've identified months or years ahead of time. And that's what gives me an edge and gives my audience an edge, because we're following these stories from long before their IPO. And so we know about the company, we know about the business model, and we've seen the amount of money they've raised and the trajectory of their business. So if you follow me, you're only going to learn about the companies that are significant in their space. Certainly AI, there's a lot of these right now, and so we're following a lot of them. And a lot of those might fall off the radar at some point in the future, or they might get acquired. So one remedy from making this mistake is to keep in mind that the top IPOs are the top businesses. We're not investing in any old IPO out there. So I recommend people monitor the startup pipeline to see which companies are the largest or the fastest growing startups in every field. So you look at AI, you look at climate, you look at software companies, and what are the most exciting industries that are up and coming and have the greatest growth potential in the next 20 years. So follow the top companies in those fields, and those are going to be tomorrow's next great IPOs. Unfortunately, they don't happen all the time. We just have to wait for them. Other times there are just well-known names that could IPO at a certain time. Name recognition can help with an IPO and with public demand, but without growth and fair pricing, it's not going to be a successful IPO. So invest in the business, not just in the IPO. Mistake number 2 is not reading the S1 filing or F1 filing if it's a foreign company. These S1 filings are really long, 300-400 pages, so nobody's going to read the whole thing. They're being written by AI right now too, so it's not like we have these amazing authors and business leaders writing these documents. They're just getting the job done for the SEC, but you still need to pay attention what's in it, and you still need to go through most of it. And when I say go through, that doesn't mean read every word, but it does mean picking out your spots in the S1 and making sure you understand each part of the S1 for that particular company. So first thing, and I think most important, is to understand the business model. If you don't understand the business model going into the IPO or just by going to the website, the S1 usually does a very good job of spelling out the business model, how these companies make money. They also talk about where their business is going, so what's in the pipeline for revenue and what's the long-term outlook for the company. You also want to see what is the business moat. Is there a moat for these companies? Obviously, just like a public company, if there's a moat in an IPOing company, then that's one that we're going to pay a little more closer attention to because it's got a good grasp on market share. Of course, you want to look at financials, and the financials are going to come out when that S1 filing is first released to the public, so there's plenty of financials in there. You also want to look at the balance sheet, how much debt is on the balance sheet, and then what are going to be the proceeds of the money that's raised in the IPO. Are they using that money to pay down debt, or are they looking to invest in growth? If it's a high debt company that's raising money, then maybe you want to see them pay down debt. But if it's in a fast growing industry and they need to catch up with competitors or they need to expand their lead, then you want to see those proceeds invested into growth. What is the growth rate of the company? Now, we've seen IPOs in 2025 with fast growing companies that had sort of not very good IPOs, and we've seen slow growth companies with not so good IPOs, and we've seen companies with no revenue have strong IPO debuts. So growth isn't the only indicator, but generally speaking, you want to find companies that are either hitting their stride with growth, accelerated revenue growth, or just having steady growth going into their IPO. Other things to look for in the S1 filing. Who's involved? Who are the founders? Who are the heavy investors in these companies? Who are the largest beneficial stakeholders? Then there's the risks. The risks are one of my pet peeves with S1 filings because they throw the kitchen sink at you. They just say every possible risk out there and they put it into the S1. This is where I think AI is really generating a lot of risks for these companies. One way to reduce that burden is to just throw that section into AI and help it parse out what's a significant risk, or maybe rank the risks and which one's actually more significant than others. And then finally, are there any major red flags? And occasionally we'll see an S1 filing where either media reports or analysts will pick up on one particular thing. I can think of Cerebras. They filed in 2024, and there was very heavy concentration risk that one of their clients was buying up something like 90% of their inventory, and they were also an investor. So there are these red flags that you have to keep an eye out for. Sometimes it's a little trickier. Ordinary investors like you and me aren't going to catch it, but you can read what other analysts are finding in terms of financial trickery or other red flags that might be an anomaly on the S1 that could lead to a canceled IPO or a lousy IPO. And if you can find research reports or even people on social media like X, you might find someone throwing out their analysis for free. So even if you're not an expert at analyzing these businesses, you can read what the experts are saying. It's better than not looking at the S1 at all, which is a common mistake, number 2 on today's list. Number 3 is expecting access to all IPOs. Investing in IPOs is a privilege. If your broker offers IPO access and if the issuer gives shares to that broker and they distribute them to you, consider it a privilege and not a right. So often I see investors who are so frustrated they may get 1 share from Robinhood or 0 shares from wherever they're investing in these IPOs, and they get frustrated by it, and it turns them away from IPO investing because that stock may go on to spike in the public markets and they feel like they missed out because the broker didn't give them the share. If you're going to be investing in IPOs over time, you need to have low expectations for the allocations you're going to get. In fact, I don't usually expect to receive much of an allocation for a lot of deals because the highest demand deals are the hardest to get shares for. I put in for Uber, I put in for Airbnb, and those deals were just very high demand. It was hard to get shares, even though there were a lot of shares outstanding. So if you're going to be investing in IPOs, expect to be disappointed, but occasionally you'll you'll get that really magical allocation of a company that has a really strong debut, and you'll see your money increase in value very quickly. So it's a patience game. It's a expectations game. You need to manage your expectations and not expect to receive IPO allocations or substantial IPO allocations for every deal. I've had deals where I've gotten 100 shares allocated to me, and that same broker might give me just 25 shares. The highest demand deals are the hardest one to get shares for. So when there's a high demand deal coming and we know it's oversubscribed and a lot of people are interested in it, be ready to be disappointed. But on some occasions, you're going to get a good allocation, and those are your opportunities to profit. Mistake number 4, when it comes to IPO investing, that is misreading demand signals. A big part of IPO investing is understanding the demand for these deals. Pre-IPO companies have a pre-IPO valuation, and then they have a post-IPO valuation, which is set by the market. It takes time for that post-IPO valuation to settle out. So when a company debuts, there's often more demand for the shares at the IPO price and above, even though fair value may be below the IPO price. It just takes time. So you have to read these demand signals to get a sense if you're going to want to participate in the IPO. The first signal we get is the initial price range, which comes out about 10 days before the IPO, 8 to 10 days before the IPO. The underwriters issue a price range, and that gives us an estimate of where the price is going to come out. And we have to compare the valuation of that price range to the pre-IPO marketplaces, where you can get estimated price valuations of these companies before they go public. And when that price range is lower than the current private valuations, that's a sign or a signal that the underwriters are trying to get a lot of eyeballs on the deal. A low-priced deal, you're going to get a lot of interest from institutional investors. Now, within a few days or so, or within about a week, sometimes they modify the price range. They might up the range. And when they up the range, that tells you that there is demand, especially institutional demand. That's where the big money is. Now, the retail brokers also feed their demand to the issuers and to the underwriters. So if Robinhood offers this IPO access to investors and there's a higher demand than usual, they feed that back to the underwriters and they'll reprice the deal. So when you see that bump in the price range from the initial price range, that's often a good signal. Sometimes we get news about oversubscription or undersubscription to a deal. These often come out from analysts on X, Twitter, or Bloomberg sometimes will release this kind of news. It'll say something like, this stock is 10 times oversubscribed. That means there's more people that want to buy the deal than not. We've seen some deals 20, 30 times oversubscribed. That means a lot of people want to buy at the IPO price. There might be a small float, which could affect that. But when you see that oversubscribed terminology used from a reputable source, usually it's Bloomberg or like a Wall Street Journal. And when you see that, it's a sign that there's high demand and it could be a positive debut or strong debut. The next signal we get, and it's probably the most important, is the final pricing. You want to see where the underwriters price the deal within the range. If it's within the range, if it's mid-range or below, that's a sign that demand is weak. And many of us who invest in a lot of deals, when we see it priced in the mid-range or below, we'll just walk away from the deal. Once you indicate interest for a deal with these brokers, you don't have to go through with it the night before. You can cancel your order, usually up to about midnight. Now, when the IPO price is at the high end of the range or outside of the range on the high end, those are also very strong signals, but you don't want to see it too far out of the range. So for example, you might see an IPO range of $30 to $33 per share. And if the IPO price is at $34, that's usually a good signal that there's strong demand for that deal. If it prices at 32, 31, you start wondering where the demand is for that deal. But sometimes the issuers, the underwriters get greedy and they price it way above the range. And we've seen this a few times where it really backfires. Gemini was the example in 2025 where they priced the deal far above its initial price range and the stock was not valued there. They got greedy, they pulled a lot of money out, and then retail investors were holding the shares as the shares fell. So we do like to see the pricing above the range, but not too far above the range, because that'll signal that the issuer is raising too much money, and oftentimes the price falls. Uber did the same thing. They priced it very high, and the result was just a flat IPO. There wasn't a lot of money to be made by retail investors. The worst IPO trap out there is when they overprice the deal and you buy at the IPO price and shares fall. We saw that a couple times in 2025. It's very frustrating. StubHub, Gemini, Navan was another one that didn't perform out of the gate, and Venture Global, another one that priced too high headed into its debut. If the deal is priced above fair value or at the low end of the price range, or if you just don't see the demand signals you want to see, it's okay to just back away from the deal and not accept the allocation. You can cancel your order the night of the IPO pricing. Mistake number 5, this is by far the biggest mistake I see, that is chasing overvalued IPOs after they debut. This is the most common mistake because any investor can make it. You don't have to have IPO access to chase an overhyped IPO. I think back to Figma. Figma opened up more than 200% above its IPO price. And anybody that bought at that price and held for any period of time is going to lose money. You don't want to buy the hot IPO out of the gate. And that's because in the secondary markets, deals are priced somewhat fairly before their IPO. And so underwriters have a lot of data to price these deals where they think it's actually valued. When you see that spike, it's due to hype and euphoria. And if you're buying up there, there's a very great risk that the stock's going to fall from there. I think back to Rivian. It was another one that spiked out of the gate and fell subsequently over the next several months. So that's the most common mistake, buying the IPO after the debut when the stock is rising or has already jumped 50 to 100%. I don't know if this is due to FOMO or if it's just traders trying to catch the momentum, but if you're an IPO investor, you don't want to be that guy chasing it. When it comes to IPOs, if I can get in at the IPO price, then I invest. If I can't get IPO access at the IPO price, I stay away. That's my personal rule. I just don't chase hot IPOs, period. And that means oftentimes I'm just going to sit on the sidelines and watch. I'm not buying it that day in the market. Several weeks later or months later, if I like the stock long term, maybe I might jump in. But I invest in IPOs to take advantage of that deliberate underpricing by the underwriters and then that euphoric debut that often lasts longer than just the first day. Stocks can stay up for quite a long time before they start to fall if they're overvalued. So the rule is simple. Don't chase overvalued IPO stocks on the first day of trading. And if the second day of trading is still going crazy, you want to stay away. And I'm sharing my screen right now of 2025 stocks, and you can see where there's a lot of green on the first day of trading, but over time, the red increases in its intensity. The losses increase over time, and a lot of the gains that happen fall as well, which leads me to mistake number 6, and that is not selling wildly overvalued IPO stocks. So when you receive an allocation of a stock at the IPO price and the stock jumps on the first day to absurd valuations, it's okay to trim some of those holdings. Now, I like to wait until the flipping policy is clear, which is either 15 or 30 days, but some of these brokers have no flipping policy. So if you're investing at a Moomoo or Webull or TradeStation, you can flip. Now, flipping is frowned upon, but if a stock is up 250% like Figma was on the first day, it is criminal to maybe not trim some of those gains. Now, you do have to balance that against the flipping policy because that can affect your ability to receive future IPO shares, especially at Fidelity, which is going to ding you permanently if you do it too many times. Robinhood, SoFi, they're a little more forgiving if you flip there. So if you're going to be a flipper, then you should invest on the platforms that allow flipping. If you are not going to be a flipper, then you just need to abide by the flipping policies. I'm sharing my screen again with this list of IPO companies in 2025. And if you look at Figma as an example, it was up 250% on the first day, and I think it was up even higher than that. But by the 15th day, it was up 140%. It's still a pretty good gain. And by 30 days, it was still up 100%. So if you got a Figma allocation at Robinhood or SoFi, you had 100% gain after 30 days. It's time to take some profits there. Now, if you look down the line here, as we got to the 90-day point, the stock had fallen. 4 months later, in November, stock's only up 7%. So you can see we went from up 250% on day one to up 7.5% 4 months later. Another example is Circle. The Circle IPO was up 168% on that first day of trading. And that's a perfectly good time to take some profits. But now if you look on day 15, that stock was up 675%, which is wild. And actually, I got an allocation of Fidelity and sold on that 16th day and locked in about 600 and some percent profit on that deal. But I only sold half of my shares. I'm going to hold the rest for a longer period of time. And the rest of those shares are down 500%, only up 126% now since the IPO price. But I did lock in those profits at that 675% level. Even at the 30-day mark, Circle was up 569%. And if you had an allocation from Robinhood or SoFi, that's a good time to sell. Listen, if you're going to be getting 100% gain in 1 or 2 days, that's going to beat most of your gains for your investing career. So when there are these crazy gains, you've got to lock in some profits. If you don't sell all of it, sell some of it to lock in some gains because they're not going to stay inflated like that. But do consider the flipping policy. Fidelity, for example, I wasn't going to flip those shares early, and thankfully I didn't flip them because the stock continued to rise. But Fidelity has that really strict policy on flippers, whereas some of these other brokers where flipping is tolerated a little bit more, you probably want to sell some with those kinds of gains. One of the members in our community, I know he's not a flipper, but when he saw Figma up 250%, he had a pretty big bet on that one. He took some profits. And the fact that he didn't get IPO access for a few months after that at Robinhood, he was okay with that. My strategy typically is to buy at the IPO price. And if the stock continues to be up at that 15-day mark at Fidelity or the 30-day mark, I will sell usually all of it unless I really want to hold those companies for a long period of time. Now, even though some of these brokers say they don't have a flipping policy, they may track you and they may ding you in the future, but you have to invest with the rules that you know. So understand the flipping policies at your broker so you can use that to make informed decisions. So when you have crazy gains in IPO investing, that's why we do this, for those crazy one-day gains or 15 or 30-day gains. Make sure you take some profits, which leads me into mistake number 7, and that is holding losers too long. Oftentimes, these IPOs enter the markets with a thud, and they're either flat or they fall on the first day. Saw this several times this year. StubHub was down 6% on its first day of trading. Navan was down 20% on its first day of trading. Gemini was up 14% on its first day of trading, but by the 15th day, it was down 11%. And you can see in the chart that I'm sharing on my screen, it just continued to fall over time. So when you're investing in these deals, you want to be a believer in the long-term viability of these companies and long-term potential. But also, if you're an IPO investor, you're in this for the short-term gains. Oftentimes, if you like the company long-term, you're going to get a chance to buy it back another time. So when you've bought an IPO that's flat or falling, you start to get a lot of market vibes telling you that this isn't going to go well. The time to sell it is right at the end of that flipping period. So if Fidelity is 15 days, Robinhood, SoFi, it's that 30-day mark. You don't want to hold these for too long unless you're really a long-term believer. When these IPO stocks open and fall, sometimes it takes time for them to find a bottom. Famously, Facebook had a terrible IPO and the stock bottomed. But once it found its bottom, it was really the opportunity of a lifetime to buy that stock. That's less common with really most IPOs. Facebook, of course, Meta is a Mag 7 now, but the chances of the next IPO being another Mag 7 someday are very low. One of the examples I had from this year was Venture Global. I invested in Venture Global at Fidelity. I got in at that IPO price, and by the 15th day, the stock was down 30%. I sold all of my Venture Global on that 16th day to get out of it. It was obviously a dud. I moved on to the next deal, and we had CoreWeave, we had Hinge Health, and Circle, which turned out to be a generational IPO. So losing with Venture Global, I wasn't discouraged, and I was able to take advantage of some of the other deals, but I didn't hold those shares too long. So when you've got a loser, I recommend selling it as soon as you can, ideally outside of the flipping period, which takes me to mistake number 8, which is ignoring the flipping policy period. So all of these brokers that offer IPO access, and there's about 8 of them, they each have a flipping policy or a no policy. And this is extremely important to understand when you're investing on a platform. Robinhood's flipping policy is if you sell shares that were offered to you as an allocation in an IPO, if you sell them within 30 days of the IPO date, then you won't get access to any more deals for the next 2 months. So if you want to invest in a lot of IPOs in the coming months, you don't want to flip shares. Oftentimes, Robinhood just gives you one share, and you might want to just sell it because why would you want one share of a loser in your portfolio? But you don't want to sell it right away. You want to hold on to it until you're past that 30-day flipping period. And they'll even give you a warning when you go to sell. Like, do you really want to do this and get penalized? Now, at least they're not penalizing you any dollars. SoFi, they also have that 30-day flipping period, but I think it's up to 120 days if you sell. They reserve the right to charge you a $50 fee or something like that. Public is another broker that's starting to offer IPO access, and for whatever reason, they've put their flipping policy at 90 days, which I think is really overbearing. Now, these other brokers, Webull, Moomoo, TradeStation, they've eliminated their flipping policies. They're not penalizing investors from flipping. And this is where I think it needs to go for all the brokers, because you need to not hand tie investors individual retail investors need to have the same opportunities and lack of restrictions compared to the institutional investors. Those institutional investors, they're flipping shares, no doubt about it. So there's no reason, I think, to make retail investors hold shares of lousy companies or not take profits when a stock is up 100%. These policies are there because it helps Robinhood and SoFi and Fidelity get shares from the issuers. When they say, well, we're going to discourage our investors from selling, and that might get them a bigger allocation, knowing that when they give shares to institutions, they're going to be selling. Now, the best way to prevent flipping is to price the deal correctly and price it right for the supply and demand, and then let retail investors do what they want with the shares. And if a deal is priced fairly, then investors aren't going to want to flip them. If there's a crazy spike, then they are going to flip them. And if there's a bad debut, then they're going to sell the shares as well so they can cut their losses. Fidelity has a shorter 15-day flipping policy, which I like that it's shorter, but if you sell within that flipping period too soon, they're going to penalize you, I think, 180 days and then 360 days for the second offense. And then the third offense, you don't get any more access to IPOs. The big mistake here is investing in IPOs without understanding the flipping policy. It should be part of your strategy if you want to invest in a lot of IPOs. And when these IPOs happen, they come in waves. You might have a couple dozen within a few month period because this perceived window is pretty short. So if 2026 turns out to be a hot year for IPOs, you don't want to get penalized by these flipping policies, especially if you're investing in a company maybe you're not that excited about, but there's another one coming down the pipeline that you really want to invest in. You don't want to be penalized at that point when you're trying to access the deal that you really want to be a part of. So let's recap the 8 common IPO investing mistakes that I see retail investors making. The first is investing in the IPO and not the business. The best businesses are going to be the best IPOs, which takes us to mistake number 2, which is not reading the S1 and understanding the business. Better yet, follow these companies from early in their life cycle as they progress toward an IPO, and by the time they release their S filing, you already know the company and you're ready to invest as long as the pricing is fair. You don't have to do this. Just go to my website and type in your favorite company. It's a pretty good chance that I've written about it and I'm already following it for you. Watch the podcast when I talk about any updates to that pipeline. Mistake number 3, expecting access to all IPOs. The way to increase your chances to get more access to IPOs is have more brokers. That's really what it comes down to. But if you're just working with one broker and you're expecting access every deal, you're going to be disappointed. So set your expectations. Mistake number 4 is misreading demand signals. Just because you are going to maybe get an allocation doesn't mean you need to accept it. If you see a lack of demand for the deal, walk away if you can. Most brokers will let you walk away from the deal the night before. You just cancel your order and you won't get an allocation the next day. If the stock spikes after that and you regret it, try not to regret it and let it discourage you. Just move on to the next deal. Number 5, the worst mistake I see all the time is chasing overhyped, overvalued IPOs after their debut. This is a solid way to lose money. When you hear negative commentary about IPO investing, this is why. People are buying at the top and riding it down. Don't chase overhyped IPOs. If I don't get access to the IPO at the IPO price, I don't invest. Mistake number 6, when you have incredible short-term gains, take some money off the table, sell at a profit, at least half if you can. If you still like the company long-term, there's a good chance you're going to have a chance to buy that in the future after the lockup periods. It's about the 180-day mark. So when you have crazy one-day gains or crazy 15, 30-day gains, take profits. Number 7, when you have a loser and you're in that IPO trap or you bought at the IPO price and the stock falls, get out as soon as you can while minding the flipping policy if possible. You're going to have some losses when you invest in IPOs. If you do it right, if you are consistent with your investing, eventually those high gains are going to offset the losses if you cut your losses as soon as you can. And finally, don't invest in IPOs without knowing the flipping policy of the broker that you're investing in. The flipping policies, unfortunately, do have to drive some of our decisions. It's one data point in our decision for selling the IPO stocks. I would like to see the SEC say this is unnecessary or the brokers just get rid of them all at the same time. There's value in issuers delivering shares to retail investors. I think the flipping policy is just bad for everybody. I guess there is a chance that maybe Robinhood is using the flipping policy to eliminate some investors so that it creates more shares available for investors who didn't participate in previous IPOs. But overall, I think it's bad for retail investors when you are investing in a market where institutional investors investors can flip their shares. It's a bit of an unfair advantage there. If you want to avoid flipping policies altogether, only invest in IPOs at brokers that don't have a flipping policy. That's all for the show this week. I'm recording this Thanksgiving week, and it's a little bit slow on the IPO radar news. So I'll be back next week with more IPO radar news and a fresh episode for you. Headed into the end of 2025, we'll look at some of the winners and losers. I'll probably bring up that spreadsheet again. And then I'll be talking about my IPO wish list for 2026. And then early in January, I'll have my upcoming IPOs episode where I try to predict which companies are going to IPO in 2026. I'll probably do a quick review of my 2025 list. While I've got your attention here, don't forget to subscribe to the YouTube channel. Hit that subscribe or like button. Or if you're watching or listening on Spotify or another podcast network, please like, follow, subscribe, whatever it takes to get these into your feed. It really helps my show grow, and it's just a little effort you can do, just like and follow. You can also head over to accessipos.com, sign up for my weekly newsletter. It comes out Sunday. I share an outline of the latest podcast and more IPO radar news. Typically that comes out in the podcast. I can cover more there. Comes to your inbox Sunday morning. Pretty light read. Subscribe there. And for those of you who want to up your game with IPO investing and feed off of what other investors are doing, other like-minded investors, how they're accessing deals, how they're buying and selling and requesting shares for IPO deals, join the Access Club. That's our Patreon membership group. Go to patreon.com/accessipos. Sign up. Access Club is just $5 per month at the baseline level. There's a free trial period so you can test it out, poke around, spy in there. But it's the best way to connect with other investors who aren't bots or AI-generated slop. And you can connect directly with me. I answer questions in there. And sometimes some of the questions get answered by other people. It's really a strong community that's grown through the volume we saw in 2025, and I feel really good about it in 2026. It's a great place to connect with humans, and that paywall gets rid of all the riffraff that you see on social media. That's all for the show. Thanks for watching. Thanks for listening, and I'll see you next week. This video is not a recommendation to buy or sell any startups mentioned. Pre-IPO and IPO investing involves significant risk. Conduct due diligence by reading the SEC S-1 filings before participating in IPOs. Do not invest in IPOs with money you cannot afford to lose. Thanks for watching.